Today's episode is brought to you by Freetrade, the commission-free investment platform. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Many investors favour stocks that pay a high dividend, opting to live off the cash they generate. But does a strategy focused on income make sense, or is there a better way to invest?
I want to know why even stingy US tech companies have started to pay dividends. And in today's dumb question of the week, what is shareholder yield? All right, let's get into it. So in investing, there seems to be few topics that are more straightforward and uncontroversial than dividends. It's just companies paying back some money to shareholders. Yet there are hugely different views on the relevance of dividends to investors. And it does get quite heated, actually, sometimes, the debate.
Yeah, I think there are the kind of valuation nerds that say, well, look, if you're paying out a dividend, you're going to be effectively handing over money to shareholders, which they would have got anyway if they reinvest that money back into the company. So that's the fundamental argument. You should be indifferent as to whether you get paid a dividend, and usually the share price falls as the dividend's paid out. So altogether, it shouldn't make an economic difference, which is true.
Yeah, I was going to say, you should probably class us as those valuation nerds. Because I don't particularly care about dividends, but I know that a lot of people do. Do you talk to a lot of people who do invest in this kind of income style? I imagine there's a lot of them in the UK.
Oh, yeah, very much so. And I think a lot of it, of course, is to do with psychology. They think that if they've got this investment in their ISA or in their SIP, then it's a lot easier if you've got an income fund, which is paying you out dividends because you don't have to sell anything. The cash just appears in your account and then you can just hoover it out. And you never have to worry about the value of your investments necessarily falling over time and selling stuff, because that's the scary bit. You know, you enter retirement, you've got a fixed size pot, and then you think, well, this is it. You know, if I start selling stuff, I'm killing the goose that lays the golden eggs.
I think a lot of people see dividends kind of like bond coupons, as in it's free money that you're being rewarded for owning the stock. Whereas in reality, it's probably not the best comparison, because a company can choose what to do with its money. It's got spare cash, it could reinvest it in the business, could look to invest or acquire another business, could buy back its own shares, it could give you the money as a dividend, could pay down some debt. Like, there's lots of things a company can do with this capital, and you benefit from all of them as a shareholder.
And this is the economic argument. But I think the practicality, if I was in retirement, I would consider this. You know, the reason why is it's low maintenance. You know, it just throws out cash and, you know, that's great. It does come with certain dangers, and I'm sure we'll come on to that later on, but it's certainly attractive on the face of it. Here's a thing which spews out cash and I don't have to do anything. Which is always a nice thing when you are in retirement. You know, you don't want to spend a lot of time managing stuff, deciding what to sell. That's all scary stuff.
And the UK market especially is skewed towards dividends. So perhaps there's an incentive on the part of fund managers to encourage people to invest in dividend funds.
Yeah, if you're listed in the UK and if you're not paying high dividends, you're in trouble, I think, because all of the UK fund managers have a very strong preference for companies that do pay out dividends, as do UK investors. So growth is a style which doesn't really fit the UK psychology and culture at the moment. That's not to say it won't in future. But I think the problem at the moment is that if you do milk your companies for dividend, then you're not going to see so much capital growth. And if you don't see so much capital growth, you don't grow the market cap. So in a way, we've destroyed our own stock market's market cap relative to the rest of the world because of the fact we've been feeding off dividends and essentially draining the lifeblood of these companies. That's one argument for why UK market cap hasn't grown.
We've been nibbling away at them and they haven't had enough cash to invest.
Vampirism, yeah.
But it's not just UK companies at the moment that seem to be attracted to dividends. So surprisingly, those big US tech companies have started to pay out dividends. So over the last 10 years, we've seen companies like Apple and Microsoft being paying dividends on a relatively low payout ratio or yield compared to British companies. But still, you might get 1 or 2% as a dividend yield. But now we've seen those more new companies like Alphabet last week announced its first ever dividend, and back in February, Meta announced a dividend. So what's going on here? Why are they joining the payout party?
I think they're realizing that if they can't offer growth, capital growth, then they have to offer something else. And perhaps that's going to be income in the future. So the dividend yield that we will get probably on the Alphabet dividend payout will be 0.5%. Now, dividend yield is the amount of income paid out, dividend paid out over the last 12 months divided by the price today. So the volatile bit is the price in the denominator. The other thing to look at is payout ratio. So that's the proportion of profit which is paid out as dividend. And that's a decision by the board. They can say, look, we've got this much money left over after we've paid our bills, our taxes, our repayments on our borrowing. And then you work out the dividend payout as a percentage of that profit. So I bet this is not going to be large for any of these tech companies. So really all they're doing here, I think, is signaling, look, we will start paying a dividend. And if you're a dividend investor, suddenly we come onto your radar. And that means they're going to be able to market their shares to a wider audience. Not just the growthy, stocky type people, but the incomey type people who are probably the ones in retirement already.
Yeah, certainly at this stage, it's a low dividend yield. So Google, 0.5%, like you say, at the time it was announced. And that won't be paid till June. And that compares to something like the FTSE 100, where the dividend yield is more like 4%, right? So it's a big difference there. But the other thing to note with these US companies is they do a lot of share buybacks. So this first quarter dividend from Google is worth around $2.5 billion in total. But it's also authorized share buybacks of $70 billion. So that sort of massively outweighs the dividend.
Yeah, in America, this is favored over dividend payouts. Also because of the way the US taxes dividends and capital gains. Capital gains have a lower tax generally, although it depends on the state you live in, whereas income is taxed more heavily.
Yeah, and that's what some people have said of why maybe there's a temptation to introduce dividends now. It's because the Biden administration did introduce a tax on share buybacks last year. So it's slightly evened the playing field maybe between dividends and share repurchases. But the weird thing about these tech companies announcing dividends for the first time is that markets don't seem to have reacted in that way we talked about at the start, where you should be indifferent to dividends. Alphabet shares surged 10% after the announcement. Now, this was at the same time as their quarterly results, which were good. So it's hard to untangle, did investors just like the earnings report or did they like this dividend? But 10% rally in a day, it took them above a 2 trillion market cap.
What's very clear is that markets took it well. At least they didn't take it badly. If they had, it would have fallen. And if we look back to Meta in February, when they announced their dividend payment, they also surged. They surged 20% on the day of the announcement. So I think as a signaling mechanism that, look, we're in good shape, we can afford to pay a dividend, we're probably buying back our shares as well, that suggests that the company's in good shape.
I think that's what it is. It's signaling to investors that the company is going to be able to pay a dividend in future, which implies it's expecting consistent and growing cash flows for years to come, right? Because markets punish you if you cut a dividend. So it's kind of holding a gun to your head and saying, we bet that we're going to keep paying a dividend.
And they also punish you for diluting your shares if you issue new shares. So the direction of travel, if you want to please your shareholders, is share buybacks, pay out a juicy dividend, and of course, reinvest into your company if you can. But you can only do that if you're generating lots of revenue. And that's what these companies have been doing.
The interesting thing to me about Meta and Alphabet is that they have been looked down upon, I think, by investors for some of their capital allocation decisions recently. So obviously Zuckerberg got a huge amount of stick for his wild spending on the metaverse, which is yet to pay off. And Google is sort of lagging behind the curve a bit on AI, despite throwing a lot of money at it. So I wonder if they've introduced a dividend to sort of say to investors, look, we get it. We're not being reckless with money here. Here's some actual money back into your pocket. So we are going to be weighing up what we do with our money carefully. Don't think we're just being willy-nilly with it.
And building up a big cash reserve is also a worrying thing because you think, well, why have you got cash? It's not earning much. And you could be investing it back into the company. If you really believed in your own company, you'd be expanding it organically. by reinvesting it. So I think that is a worrying sign if you see lots of cash on the balance sheet. Or perhaps they're building up a war chest for acquisitions. That's the other reason why you might do it. Or preparing for a really bad economic rout. But at the moment, I just don't see that in the US. I don't see a huge fall in growth around the corner.
There's certainly companies which are cash juggernauts. Their free cash flow is huge. So at the end of 2023, Alphabet had around $111 billion of cash equivalents, and marketable securities. And Meta had $65 billion worth. This is a lot of money. Like, it's a big acquisition if you're saving that money to go and buy another company. And if you look at what's happened with antitrust in the US, we've talked about this on a podcast recently. I don't know that Alphabet or Meta are going to be allowed to go and buy another company of that size. So what do you do with the money? You either throw it into AI investments or you start to return it to shareholders, right?
Yeah, so I think you're right. Their hands are tied in some ways, certainly when it comes to acquisitions. And if they want to avoid these antitrust laws and the notice of politicians, then, yeah, dividends are a safe bet.
It does seem to mark a turning point to me. I know these are small dividends, relatively speaking, but now it's the case that 8 of the 10 largest US companies are paying quarterly dividends, which is a big turnaround. So it's like these big tech companies have matured now.
And boring. I think that's the truth of it. They've become not exciting, innovative companies, or not as exciting. They're just plodding along and doing okay. Well, very well at this stage. But the way Aswath Damodaran describes it is that this is kind of like a life cycle of a company where you start off as a scrappy startup with huge growth and very high business risk. And then you mature to the point where you're not so capital hungry. You're not worried about getting capital through the door. You've got enough capital and your growth slows down. And then you can start to pay dividends. And they've reached this stage quite a while back. I think they've delayed it really. Because the other signaling which this is giving out is, okay, we're not as exciting as we were. We can't grow as fast as we did. But look, have this dividend.
If anything, it should be applauded. It's like they've made it through their teenage years. Now they're out in the world paying their own way.
And I think it's a realization also that if interest rates are higher now, then if you don't pay a dividend at all, and you also don't have the capital growth that they had in the past, well, you better pay a dividend. Otherwise, you won't look so attractive now.
So we said that 8 of the top 10 companies in the US now pay dividends. Do you know what are the only 2 that aren't?
I wouldn't have if I hadn't looked at the notes, Michael.
Stop looking at my notes. Every week.
So it's Amazon and Berkshire Hathaway. Those are the only 2 in the top 10 that don't pay a dividend. Interesting that Berkshire doesn't.
Well, Berkshire's a funny one because it's an investment company, right? So I kind of think investors are giving their money effectively to Warren Buffett and saying, go out and get me return. Don't just give it back to me, Warren. Go and find companies to buy.
Yeah, I guess you could say that about a lot of stocks, though. The deal's usually the same, which is I want capital growth. Certainly in the US, that's true.
Berkshire's never paid a dividend. It's interesting that Amazon doesn't. Maybe it'll introduce one, though I've sort of seen some people saying its earnings are far more volatile than the other big tech companies, partly because it depends on consumer sentiment, their retail business, and also because they have a lot of investments in other listed securities like Rivian, which go up and down all the time. And with gap rules, you have to mark to market all the time. And it's just harder, I think, for them to predict cash flow. And they operate on much lower margins. There's a lot less room for error than there is with Alphabet and Meta. But we'll see. Maybe they'll join the party too.
Even Amazon Web Services is a cyclical venture because if you're providing infrastructure for other companies, IT infrastructure, then that will be cyclical. They will cut back if the economy starts growing more slowly. That's the problem. You're right. I think they have a more volatile revenue, so it's more risky if they're going to pay out a dividend.
The thing you mentioned earlier about companies introducing dividends and then potentially being eligible for ETFs and mutual funds, which only invest in dividend-paying companies, do you think that could be a big effect? Is it good for Alphabet that, maybe now you'll get in some dividend aristocratic kind of index eventually?
I think so. I think in America, generally people invest for capital gain. That's the deal. In the UK, we invest for income often. But perhaps this reflects a shift in demand in the United States, and there will be more of a shift to income investing. Certainly as the population ages, I'd expect that to be true.
I saw a note from Goldman Sachs analysts which said that once a company starts paying a dividend in America, over the next year, these dividend-focused funds end up buying around 0.5% of the company's outstanding shares, which might not sound like a lot, but it's still a net inflow into the stock.
And as the ETF universe grows, a subset of which is dividend funds, then I think this will be more of a consideration for companies.
Is it really just over the last 10 to 15 years since the financial crisis with low interest rates and growth stocks being the massive outperformers? Is it just in that environment where we've seen dividends kind of deprioritized? Throughout much of the rest of history, when it comes to stocks, dividends are just sort of a normal part of what a company does, right?
Yeah, I think that's true. And that's been true since day one, when we first had the creation of companies, limited companies, which is about 400 years ago. And the US used to pay out higher dividends. If you look back over time and look at the long-term history of the S&P, it kind of fell, I think it was in the 70s when the dividend yield fell by quite a lot. Maybe that was the change in the law about the way US investors are taxed based on income and capital gain. But that was quite a marked change, and it hasn't really increased much since then. And this is payout ratio I'm talking about, the percentage of profits which they pay out.
That's interesting. I didn't know that. Do you think that effect you mentioned earlier, where potentially introducing a dividend starts to bleed the company's cash reserves, if it's too chunky at least, and therefore capital gain should be lower, is that necessarily true? Like on paper it should be, but then Microsoft introduced a dividend in 2003 and has performed amazingly since then. Likewise, Apple introduced a dividend in 2012 and has done really well since then. Is it more a case of it's the level of the dividend which matters? Don't overcommit yourself as a company.
Yeah, I mean, the way to think of it, I think, is in terms of how bond-like your company is. You look at companies in the FTSE 100, and there are quite a few of them which are bond-like in the sense that they just throw out dividends. There's not much capital gain. Perhaps they match inflation with the capital gain. That's all they've got to do, really. And then effectively, you've got a bond. And in fact, if you look at the FTSE 100 right now, there are quite a few companies which have a payout ratio over 100%, because these are companies where they don't cut their dividend ever, because that's the deal, right? If you buy our company, then you get this growing dividend. And if their revenue falls, they're not really going to step back and say, oh, we're going to stop paying dividend or cut our dividend, because that would be suicidal.
I'm guessing they're issuing debt then to plug the gap.
Can be, or it can be cash reserves. They can start to run down their cash reserves. They have a buffer, perhaps, in order to do that. But it's shocking how many of them have a payout ratio greater than 100%. Some of them far greater. And sometimes it's a crisis, right? So if you look at water companies in the UK, a couple of those have very high payout ratios. But this just reflects the fact that they haven't cut the dividend yet.
Haven't cut off the flow of sewage into the sea either.
Or the rivers, yeah.
Yeah.
Yeah, there was a dump into the local river, literally, which is a lovely chalk stream, the Misbourne.
It was.
It was.
Yeah.
It's a sewer. Yeah.
Now there's three-eyed fish swimming around.
Today's podcast is sponsored by Freetrade. Freetrade is offering a free share worth between £10 and £100 exclusively for Many Happy Returns listeners. Simply download the app, fund your account with at least £50 and get a free share today. Ready to claim your free share? Head over to freetrade.io/PensionCraft today. You can also find the link in the show notes. Freetrade is an award-winning investment app with over 1.5 million UK registered users. You can invest commission-free in over 6,200 UK, US and European stocks and ETFs. Looking for more than simply commission-free investing, Freetrade offers tax-efficient investing through a stocks and shares ISA and a self-invested personal pension. Join over 1.5 million UK registered users on Freetrade and claim your free share today. Capital at risk, other charges apply, ISA and SIPP eligibility and tax rules apply. The probability is weighted, so more expensive shares will be rarer. Terms and conditions apply. But I think the signalling thing is interesting because I used to work in kind of biophysics and then I worked in cognitive science. I was interested in signalling when I worked on language models. And I worked in the experimental psychology department in Oxford, which is right next to the zoology department, which is where Richard Dawkins was. And I love his books. And one of the things he often talks about is the peacock's tail, which is this incredibly expensive thing. If you imagine you're a peacock.
I frequently do.
You have to preen this thing. If you have to fly, it's incredibly energetic, just to drag it behind you. And yet lady peacocks evidently like it a lot. So I think it is a signaling thing. Look, I can maintain this ridiculous thing on my back and yet still survive and look pretty good.
Yeah, it's the males that have the big tail, isn't it?
Yeah.
In almost all species, it's the males that have to show off. It's just in humans where we are allowed to just wander around in our fat face clothes and still pick up birds.
Steady. Yeah, this is a sore point, it has to be said. But I guess this signaling thing is an important one for investors. You've got to be able to say, look, this company is paying a high dividend, evidently thinks it can afford to continue servicing it, and that suggests that it's healthy. So I think that is a really important signaling channel for the company and for its board to its investors.
I think for sophisticated investors, institutional investors, people who are actually thinking about it,
yeah,
that makes sense. But I get the feeling that a lot of people in the UK just think of dividends as something entirely different to capital growth. They think of it like a bond coupon and they just think bigger number better. Let's buy companies where we can see a massive dividend yield.
Yeah, I've spoken to people who do think that way and, they're just saying, look, this is a certain bet because this thing's paying out a 6% dividend. So that's enough for me. I don't want any more. I think the real problem comes when you look at the capital gains for those companies. And certainly there's one UK iShares fund, which is IUKD. It's the iShares UK Dividend UCITS ETF. If you look at the real value of that fund over time, and it's been around for ages, decades, it's fallen in value hugely and it hasn't kept up with inflation. And I made a video on YouTube called Dodging Dividend Disaster, which apart from being a master stroke of alliteration, just tried to highlight this problem when you're investing in really high dividend paying stocks. So I tracked this fund from 2005 to 2023, which is when I made the video. And in real terms, the value of the fund fell 60% over that period of time. And that means that if you'd put, say, 100 into the fund in 2005, it would now be worth £40. And your income would also have fallen by 60% in real terms. So this is the danger. If the capital growth of the companies you invest in doesn't keep up with inflation, that means that your real income will fall over time. And that's the disaster I was talking about. And this is one of the reasons why I think investing in US companies which pay out a dividend is usually not a bad idea because they tend to grow more.
This gets to the heart of the question I think most of our listeners would care about, which is, do dividend paying stocks or high dividend paying stocks, do they outperform over the long term?
So the thing to remember here is that if a company is paying out a high dividend relative to its price, then that's a measure of low valuation. In other words, the company's cheap relative to the income it's paying out. So indirectly, what you're buying here is a value stock when you go for high dividend. Now, sometimes that's because the price has crashed and that's pushed up the dividend yield. So there also has to be another filter which ensures that's not true. And maybe you'd have some kind of quality filter as well. And there are quality dividend funds which explicitly do that. They look for good dividend growth. They look for a strong balance sheet as well as high dividend payout.
That's kind of what I came across when I tried to answer the question of, do high dividend stocks typically have a higher total return in the long term? It's like, maybe you could make that case, but it's better explained by other factors. So there was a piece in Morningstar where they looked at two US funds, the Vanguard Dividend Appreciation Fund and the ProShares S&P 500 Dividend Aristocrats Fund. Both funds focused on companies with very high dividends. And what they found was that you can decompose the returns of those funds into these different factors. And the most important factor is quality, which actually explains quite a lot of the returns. Value is about half as important. It is skewed to value still. And it has a negative size tilt, as in the companies in these indices are bigger than the market average.
But if I was going to do this, I think I'd do that explicitly. I'd look for quality combined with high dividend yield. That's the tilt I'd go for.
The other thing to note is that their beta is below 1, which means that in a down market, they should outperform slightly. And in an up market, they should underperform slightly. Like their swings will be less volatile, typically.
But that was fairly small. The VIG fund, the Vanguard Dividend Appreciation one, the beta was a bit smaller, wasn't it? 0.92 versus 0.95 for the other one. But you're right. These are kind of boring in the sense that they don't outperform the index. They're a little bit cautious.
Perhaps the most interesting line on the analysis was that their alpha is negative.
Yeah.
So you're not actually gaining any outperformance versus the market. It's best explained by these other factors.
So if you are going to go down this route of comparing different funds which have different dividend yields, I think it's a good idea to control for this factor tilt as well, because that can certainly affect the outcomes.
But putting all this mathsy analysis to one side, which kind of decomposes why these funds perform as they do, I think it's fair to say that retail investors generally favour dividends. A lot of them do. And as we said, that's maybe irrational, just based on how corporate finance works. A pound is a pound, whether it's paid to you in dividend or kept within the company and invested. So why do you think investors favour dividends?
I think there's a trust element here. So let's imagine that the company pays you cash and that goes into your brokerage account and then you can reinvest it. It's about control as well, because then you decide how to reinvest it. You don't even have to reinvest it back into that company. So I think from the element of control, it's a positive. Also, you may not trust them to reinvest that money back into their own company to generate organic growth because it may not be successful. If they reinvest it, it doesn't mean that that expansion is going to increase their future profits. It could be something like the metaverse, which just looks like a money pit, which isn't going to pay off. So if the CEO starts to go slightly loopy, and I could give some examples here. For example, a company that starts investing heavily in Bitcoin. I won't name names.
You invested in MicroStrategy. Oh, I've named names.
And I did very well eventually. But only because of the tax loophole, which is that in the UK you can hold it inside an ISA, whereas with Bitcoin you can't.
Okay. But what you're saying is if a CEO goes off-piste and starts spending the money in a way that you wouldn't like as an investor, you'd rather the money in your pocket today.
I think that's the point. It's a matter of trust.
I came across an interesting academic paper called The Dividend Disconnect, which is by Hasmark and Solomon from 2018. And they look at this exact question and they attribute the bias towards dividend from investors to behavioral biases. And to quote, many individual investors, mutual funds, and institutions trade as if dividends and capital gains are disconnected attributes, not fully appreciating that dividends result in price decreases. Behavioral trading patterns, for example, the disposition effect, and just to explain that briefly, that's the phenomenon where investors are more likely to sell stocks that have gone up in price and less likely to sell ones that have gone down. Maybe the opposite of what you should do. Anyway, those trading patterns are driven by price changes instead of total returns. So investors actually rarely reinvest the dividends when you look at the data and trade as if they're a separate, stable source of income, which is kind of what we talked about earlier, that investors see dividends as just cash in their pocket. Let's go out and spend it on a new TV or a car or whatever. And I'm making my investment decisions whether to sell or buy a stock based on the price action, not looking at total return.
And that's a fundamental problem, right? You should always think in terms of total return because that's what matters.
Interestingly, the paper also found this effect from stock analysts, professional stock analysts, where they are more optimistic in their forecasts for dividend-paying stocks. Again, because they overlook this effect where the price reacts to dividend payouts.
Is that true?
I don't know. This is what this paper says.
I just can't believe that someone who's trained in discounted cash flow analysis would kind of ignore that effect. But still, so the actual statement in the paper is interesting. They say if the free dividends fallacy is widespread, the free dividends fallacy is this ignoring of the falling in the share price when a dividend is paid out. It should be evident in the actions of other market participants. So they look at analysts' forecasts of future stock prices to see if they show this bias for dividend-paying firms. And empirically, that's exactly what they find. So maybe it is true.
Yeah, they say, consistent with the free dividends fallacy, we find that the price forecast error is significantly more negative for firms with a high dividend yield. Like, if that stands up as a fact, it's kind of incredible, isn't it?
That's pretty shocking.
You must be able to trade against that if you're a hedge fund. There was one other paper I came across which was interesting, which was called Consuming Dividends by Brower, Hackathal and Hanspel in 2021. And the basic summary of that is that they looked at a load of bank data and showed that on days that dividends are paid out to investors, investors go out and spend that cash very, very quickly, which would imply they're not thinking about total return. They're seeing it as an income stream to be spent.
Shall I tell you a shocking fact?
Yes.
Yesterday, I went to the Biltong shop in Amersham and I had to top up for Ted and Laura. And what I found was empty shelves. And so I said to the lady, what happened? And she said, well, firstly, there was a rugby game on the weekend. So people just tank up on Biltong for that, which is interesting. And her second point was that it was payday. So apparently people wait until payday and then they go and fill up their Biltong reserves when they get paid, which I found pretty surprising. I mean, do you change your consumption when you get paid?
If you're living paycheck to paycheck, I guess you do.
I was surprised by that.
But this paper was basically making the point that people aren't typically reinvesting the dividends, they're spending them, which you could do by selling stock, right? This is the whole point. It doesn't necessarily have to come from dividends.
But this is kind of ignoring a new innovation that you get on some platforms nowadays, where you can reinvest the income automatically. You don't even have to think about it. That's just a click of a button. But I think it's certainly true that if you had to physically reinvest it, you'd be tempted to take the money out. But if it's automatically being reinvested, you can encourage yourself to do the right thing.
I like accumulation funds, especially within tax shelters, because there's no reinvestment needed. The fund manager's doing that for you. To me, the whole dividends argument is a strange one because I largely hold accumulation funds. I only think in total return terms. So I always have to remind myself that not everyone thinks that way and they separate it out mentally. I just don't see dividend payments very often.
But you're still in the accumulation phase. I think the difficulty is when you're in the decumulation phase, when you've retired and you have to sell stuff, it is scary. You are selling your nest egg and, income funds psychologically, I think, make that easier. Maybe that's why it's easier for you at this point in your investment career to think of it in those terms.
That's a really fair point. Do you think the FTSE 100 will still be around when I retire to pay me an income? What do you reckon?
Yeah, but its market cap is going to be like £1 million. Now, whatever point in your investment career you're at, whether you're building up your investment pot or whether you're drawing down on your retirement pot, you can learn from other people who are going through the same experience. And that's one of the benefits we offer with our membership. If you want to join us, just look at our website, PensionCraft.com, to learn more.
Okay, today's dumb question of the week is, what is shareholder yield? Now, we've talked about dividend yield. How does that compare to shareholder yield? Sounds like it should be a broader thing.
Yeah, certainly for the US, it's something that people often look at. Aswath Damodaran is someone who does this. So when he looks at comparing stocks, he always talks about shareholder yield. But the basic idea is that you consider everything that matters to you. So cash dividends are one thing. That's a benefit. So are share repurchases, because they push up the share price, they give you a capital gain. And another thing which goes into the formula is net debt pay down.
And so the shareholder yield is those three things combined: dividends, buybacks, and debt pay down, divided by the market cap of the company to give you the yield.
Now, net debt pay down is a difficult one, I think, because the other two are kind of goodies. The net debt pay down is something which you don't immediately see as a benefit. It does mean less debt servicing costs in future, but it means that some cash is effectively being taken out of your pocket and paid back to your lenders.
The reason I think academics use this definition and include debt pay down is because it's a guaranteed return.
Yeah.
You're paying off debt at a fixed interest rate, and that's guaranteed return. Whereas if the company is investing it in their own operations or in an acquisition, there's uncertainty about what you're going to get there.
It's kind of like paying off your mortgage early. It's not very exciting, but it does effectively put more money in your pocket every month. But you just look at the amount of cash you have to put in to get a certain payoff, and you just think, oh, no, I'm not going to do that.
Not going to run down my biltong purchases for that.
Absolutely. Biltong today.
The other thing to note, I think, about this shareholder yield formula is its net share repurchases. What do we mean by net? A buyback's a buyback, right? Yeah, but a buyback's only one part of the equation. The other half is that companies are always issuing new stock and diluting existing shareholders. Now they're issuing new stock maybe to raise equity or to reward their staff, that kind of thing. So it's the net share repurchases that matter.
And if we do compare shareholder yield with dividend yield, there's a nice article by O'Shaughnessy Asset Management where they look at shareholder yield, but what they also do is look at high shareholder yield companies, but combine that with a quality filter. And they say that's an absolutely stunning combination of factors. Unfortunately, their data fizzles out in 2013, so it would be interesting to do the comparison again today.
Yeah, I see a graph from 1981 to 2013, and it looks like investing based on dividend yield very slightly outperforms the S&P 500, presumably explained by the factor tilts we talked about earlier. If you go by shareholder yield, it significantly outperforms the S&P 500, more than double the return by the looks of things. And if you combine the shareholder yield with a high quality filter over that period, according to their data, it's just an incredible outperformer.
So I'd love to see a more recent analysis of that. But value, of course, has been underperforming since then, and growth has been doing much better. So I don't know if that's going to continue. But to wipe out that kind of outperformance over a 30-year period would take a while.
I mean, I really like Jim O'Shaughnessy. He does great podcasts and great articles. So I kind of put some stock in his numbers. It doesn't just seem to be data mining.
But also I think it makes intuitive sense that if you do go for companies which have a strong balance sheet, as well as having, these kind of high payouts for shareholder yield, of course, then I think, why wouldn't that outperform?
Well, it's the same thing we always say. It should be priced in, right? If there's an identified outperformance, like why should a quality stock outperform? They should just be more expensive to begin with.
And personally, I do prefer shareholder yield. And that's because increasingly what we're seeing in the UK are buybacks in UK companies. Previously, this was very much a US phenomenon globally, but we are starting to see UK companies do this too now. So I think it makes more sense to look at the whole picture in terms of things which benefit investors, and ignoring share buybacks, I think, would be a mistake.
The components of shareholder yield, I think, are interesting because it's calculated on a trailing 12-month basis, right? How much cash have you got as an investor over the last 12 months compared to the price today? And to me, it seems that those three different elements, the dividends, the share buybacks, and the debt paydown, are not as sticky as each other. I would think, for instance, that dividends are more sticky than buybacks because a dividend, you're committing to it on a quarterly basis. You're going to get punished by the market if you cut it. Whereas with the buyback, typically you're saying, we've been authorized by the board to buy up to, $1 billion of our stock back. It doesn't mean you have to do it all. And you can also time it and be opportunistic when you think there's a dip in the market. And debt pay down only goes so far. Once you pay down loads of debt, it becomes inefficient to keep paying it down. So I would actually value the dividend portion of that shareholder yield probably a little bit higher than the other two, just because it's stickier, I would have thought.
Yeah, you don't get punished if you're not going to buy back your own shares. You're right. Whereas the dividend cut is seen as being a terrible thing by shareholders.
Yeah, companies will do almost anything before they cut their dividend, except cut the CEO pay. That would be the only thing worse. Thank you for joining us for Many Happy Returns. Do send us your questions, no matter how dumb, at the email address mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.